This is your technical update from the LMAX Exchange Research and Analytics Desk for Wednesday, March 23rd, 2016. Euro dollar. So the euro is pulled back after stalling out ahead of the 2016 peak from February at 113.77, with the market now retracing back below 112. At this point, it's too difficult to determine whether the market is ready for a bearish resumption, and it would take a break back below 110.58 to confirm or strengthen that outlook and accelerate declines. Until then, there is still risk that there's potential for a higher low ahead of a fresh push higher back above 113.77 and towards next key resistance at 114.95 further up. Again, it would take a close back below 110.58 to put the official pressure back on the downside. Sterling dollar. So some intense setbacks in cable and recent trade after the market stalled out at 145.15. The next key support comes in at 140.53, which is representative of that low that we saw back on the 16th of March. A break below 140.53 would then expose the recent 7-year low at 138.36, which guards against that critical multi-year base at 135 further down. At this point, it's going to take a break back above 146.68, the high that we saw back on the 4th of February, to alleviate immediate downside pressure in sterling dollar. Dollar yen. So dollar yen has seen a bit of a bounce in recent trade off those recent multi-month lows at 110.67 set last week. At this point, though, any rallies are classified as corrective, and only a break back above the 115 handle would take the immediate pressure off the downside. Euro Swiss. So Euro Swiss has been caught in a multi-month consolidation, though overall the broader recovery outlook and the broader recovery structure remains intact, with dips expected to continue to be well supported in favor of the next upside extension beyond the recent multi-month high at 112 further up, which would expose 115 above there. Any setback should be very well supported towards 108, with only a breakback below the multi-week range low at 107.15 to compromise this constructive outlook for Euro Swiss. Aussie dollar. So Aussie has since broken out above previous resistance at 73.85, and this has put the pressure on the top side, with the market potentially seen towards next key medium-term resistance at 78.50. Overall, the broader downtrend does remain intact, so there is risk of the market stalling out at any moment, though it would take a break back below that previous resistance at 73.85 to officially put the pressure back on the downside. Dollar CAD. So dollar CAD is spaced out in recent trade, with the market trading all the way down just shy of that 28.32 critical October base. At this point, there is still risk that the market reverses lower and retests that 28.32 base, though signs of basing over the recent trade do potentially warn of a more significant reversal over the coming sessions. But it's going to take a break back above the 134.05 area to really officially take the immediate pressure off the downside and suggest that the market is finally ready for a more meaningful resumption of the longer-term uptrend, which saw a break to 46.90 near 13-year highs back in January. Kiwi dollar. So Kiwi remains very well capped on any form of a rally, with the 69 level acting as formidable medium-term resistance. At this point, deeper setbacks are favored, with a breakback below 65.46 to strengthen the bearish outlook and accelerate declines towards medium-term support at 63.47 further down. Only a close back above 69 would take the immediate pressure off the downside. SPX 500. So the S&P 500 has enjoyed a formidable rally since the February multi-month low, but at this point the market should start to stall out in favor of the next medium-term lower top and bearish declines and resumption back towards 1808 and below, exposing a measured move towards potentially the 1550 area. At this point, only a weekly close back above 2050 would compromise this newly adopted bearish outlook for the S&P 500. Gold. So gold has seen some minor setbacks in recent trade, though overall any setback should be very well supported on dips to some previous resistance now turned support in the 1190 area. Only a close back below 1190 on a weekly basis would take the immediate pressure off the top side, with the market looking for the next higher low and consolidating ahead of fresh upside towards the 2015 peak in the form of that January high in 2015 at 1307.